Hey, what's going on, everybody? Today we're going to talk about a company that I bought last year, and this video is about why I invested $25,000 into Taiwan Semiconductor Manufacturing Company. All right, now if you're new to the channel, please make sure you go out and subscribe, hit that like button, share this video, and let's build this generational wealth together. All right, so now Taiwan Semiconductor, first for disclosure, I didn't have $25,000 just sitting around. This occurred in my Roth IRA, and I had to sell something else that I'd owned for about 9 years, and maybe I'll talk about that in a later video to come up with the cash. But Taiwan Semiconductor, November 5th, 2025, I bought 85 shares. The price on that particular day was $295.21. And as you can see, it was $25,000 that was invested in Taiwan Semiconductor on this particular day. Now, if you look at the company, Taiwan Semiconductor, this comes from the investor relations section on their website. Taiwan Semi has provided excellent financial performance since it went public in 1994. So this 32 years. It's the only foundry that consistently delivers excellent financial results. Delivered 18.2% revenue growth, compound annual growth rate, and 17.9% earnings compound annual growth rate since listed in 1994. So this is about 32 years. Strategic objective from the rest of the decade, from 2024 to 2029, is a revenue compound annual growth rate around 20%, gross margins to be 53% or higher, and return on equity to be 25% through the cycle. That is fantastic. They have a fortress balance sheet. They have a really good balance sheet, highest credit rating, and they relied on internal generated funds to finance organic growth. So they're not having to utilize a lot of debt to grow the business. And anytime you can have a great business that can grow its earnings and revenue organically without having to take on a lot of extra debt, they're able to use the equity in the business and they're able to grow organically. So you're looking at a great business. Now, I learned my investment styles from Philip Fisher, from studying him and studying Warren Buffett. And Philip Fisher always espoused to look for the truly outstanding business that you can buy and that you can own for a long period of time. Taiwan Semi is one of those businesses. So I always look back and say, well, how did the business perform? So you've seen over the last almost 32 years that it's grown at roughly 18% a year. Now, I went back and looked at what would $25,000 invested in Taiwan Semi be worth today on the day of its listing in 1994. So that $25,000 would be worth $1.5 million. So an annual return of roughly around 16%. So technically, that means that the business has grown roughly around 18%, and the stock price return is roughly around 16%. So that means that the business growth technically has really outpaced the stock, which is what you want. So you could have bought Taiwan Semi pretty much any month for the last 32 years, and on average, or you could have bought it every month really, for the last 32 years. Sometimes it would have been overvalued technically, sometimes it probably would have been undervalued, but on average, you would have paid less for the stock than the rate that the business was growing, which is fantastic. So these are some of Taiwan Semi's largest customers. So Apple, Qualcomm, AMD, Broadcom, NVIDIA. So they have great companies that have a lot of cash that they can spend, so they're not relying upon the consumers. In their last quarterly report, Taiwan Semi, which was just last month, they delivered another record quarter as profit jumps 35%, fueled by robust AI chip demand. I hear people talk about AI bubbles and this and that, but when a company that's manufacturing all these chips that these companies design is recording record profit, hey, I just gonna look at continuing to own this business. The world's largest contract chip maker has now posted year-over-year profit growth for 8 consecutive quarters. That's fantastic. Now, if you look at the growth analysis, Over the last 5 years, the average earnings per share has been roughly around 27% per year. So it's actually been growing more over the last year than over the previous 32 years. And a lot has to do with the big boom that's going on with artificial intelligence. If you look at the price right now, the forward PE ratio is around 23. So the price to earnings ratio is less than the earnings per share growth rate. The PEG ratio, I just looked today in Charles Schwab, was less than 1. A PEG ratio, a price to earnings growth ratio above 2, typically signifies a stock that's probably expensive. Less than 1 typically signifies a stock that's cheap relative to its growth. And typically, if it's less than 1.5, I'm good with it. If it gets down less than 1.2 or 1.25, that really gets me excited. So I feel like buying the stock at a great time when it's beneath or below its growth rate should still can create really good long-term financial growth for my investments. So, and I plan on owning this business for the rest of my life. I'm in the Charlie Munger phase. I'm not looking for businesses that I can exit. I'm looking for businesses that I can own that will stay in my family for decades to come, even when I am no longer walking this earth. So the revenue growth over the last 5 years has averaged 23% per year, and so has the cash flow has averaged 23% per year. And you can see that the estimated growth for 2026 is averaged to be 28% per year. So just a little glimpse of the balance sheet. And if I just look at the total assets and the total liabilities, and I always look at things over a period of years, not always 1 year versus the next year, but look at it over a period of years. And you can see that in 2021, the total assets were 134 billion, and last year they were 253 billion. It's a lot of growth. The debt, pretty much not that much growth in the debt, from 27 billion to 31 billion. The total liabilities, 80 billion. So the total equity, which is the total assets minus the total liability, you see that's grown from 78 billion in 2021 to 172 billion in 2025. And that's what you want to own. You want to own businesses, at least for me and my family. I want to own businesses that show consistent growth over long periods of time. This is just over a 5-year period, but I've already looked back over how it's grown over a 32-year period. So that consistent growth of owning a great business, that also shows that you can own a great business for decades. It doesn't have to, you don't have to buy a stock and then wait for the stock price to go up to a certain amount and sell it and find something else. Find great businesses that are growing that you can own for a lifetime. So the income statement, just a little look at it. You see the total revenue, 57 billion back in 2021 and 121 billion in 2025. If you look, you can see there was a dip between 2022 and 2023. It was 73 billion and it went down to 70 billion. That's why I always look at growth over a period of years, because it is not necessary for a company to always show growth from 1 year to the next. Now, revenue by itself really doesn't mean anything, because the company can have growing revenue, but is that revenue being turned into actual profit? Because this just shows, it doesn't show the full breakdown, but under the revenue, there's always the cost of revenue. What is the cost to generate that revenue? And after that, you have gross profit. Then from the gross profit, you got to take the operating expenses. So you subtract out the operating expenses, and that gives you the operating income. And then you got to take out the taxes. And then eventually you come up with the net income, and that's the net income that belongs to the shareholders. And you can see the net income was 21 billion in 2021 and 54 billion. So it's doubled over the last 5 years. Again, that's what you want to see. You want to see companies that are growing, because if the company is growing, your investment dollars are going to continue to grow as well. And that's what's important, just having businesses that can continue to grow and that can create wealth long-term for your family. A couple of other things here. You see the net profit margin on the right is 45%. The net profit, that means pretty much 45 cents of every dollar that comes in is kept as net profit. That is fantastic. That is absolutely fantastic. Return on equity, 35%. So it's even higher than what they want. They want to have for return on equity is above 25%. Anything above 20 would be very, very good. So 35% return on equity is fantastic. The earnings per share growth rate or forecast for the next 3 to 5 years is anticipated to grow at 32% a year. And that's great. That's great. If the earnings grow at 32% a year, and right now the forward price to earnings ratio is 23, that means that your growth is the price you're paying for the stock is less than the growth if it grows at that particular rate. So that's a fantastic thing. On the left hand side, you see cash flow margin of 63%. Typically, a cash flow margin greater than 20% signals strong financial health, liquidity, and ability to fund growth. If it was less than 10%, that may indicate operational struggles within a business. So a 63% cash flow margin is absolutely fantastic. So again, the most important thing is for me is to look for great businesses that I can buy, that I can own for a long period of time. And that is how long-term generational wealth can be built, by just owning great businesses. I view Taiwan Semi as a great business. It manufactures a lot of the chips that are designed by these companies, by the Broadcoms, by the AMDs, by the NVIDIA. So they are also going to be investing over $200 billion into the United States to build new factories in Arizona and Texas. So they are expanding and growing from a standpoint of what they're actually doing. So companies like this, I plan on owning for a very, very long time. My daughters own it, and that company can be passed on. Wealthy people own businesses in their families for decades. I could have owned it for the last 32 years. Hey, maybe I own it for the next 30 or 50 or 70 or 100 years. Who knows? If they're able to invest $200 billion over the course of time, that means that the company, and they've demonstrated their ability to really utilize their own capital, and they have really smart management. Great businesses with great management. They have a wide moat, so it's difficult for any other business to come and take and do what they do. Companies can't just come in and take their space. They're very unique in what they do. So my objective is to always look for great businesses to buy to own. I don't trade stocks at all. I am a true long-term investor. And if you find great businesses that you can own, that generate their own growth, and you don't have to trade in and out, you don't have to jump around from one stock to the next, and you don't have to worry about what's going on in the stock market. Stocks are going to go up and down all the time. They're doing that right now. You know, they did it last year during the tariff stuff. They're going to do it probably later this year. They're going to do it next year. Yeah, stocks are always going to go up and down. But if you own great businesses, you don't have to worry about trying to jump up and down and do all these things with the stock. Just own the business. That's what I plan on doing. So, own great businesses. Allow your money to compound. Compounding is the key. Compounding is the key. That's why Einstein called it the eighth wonder of the world. The greatest force in the universe. This tremendous power of compounding. All right, so have a great day. I will talk to you soon. Remember to like, share, and subscribe. Make sure you subscribe. All right, talk to you later. Have a great day.